present here. On behalf of the Bombay Chamber of Commerce and Industry, I, Gayatri Vinayak, would like to extend a warm welcome to all. The topic for today's panel discussion is SM REITs, Path to Compliance and Growth. India's SM REITs market is expected to exceed $60 billion by 2026, driven by Mumbai's substantial completed stock. Enhanced transparency, investor protection and recent tax reforms under the Union Budget 24-25 make SM REITs an attractive investment option. As SM REITs gain momentum, they are poised to revitalize the commercial real estate market and bolster investor confidence. With this background, the Bombay Chamber is hosting this panel discussion to delve into the challenges and opportunities associated with the SM REITs in India. The event strives to explore their relevance in the Indian context and chart a path forward for their sustainable growth and impact in today's economic environment. I now request Mr. Ashith Kampani, Board Member and Chair PNVC Committee, Bombay Chamber and Chairperson Cosmic Mandala 15 Group to deliver the welcome address. So, thank you.
Shri Pramod, Executive Director SEBI, and respected guest joining us today. It is my honor to welcome you all to the SM REITs Conclave, SM REIT 2.0 Path to Compliance and Growth, organized by Bombay Chamber of Commerce and Industry, India's oldest Chamber of Commerce. I extend my heartfelt thanks to Shri Rao and our distinguished guest for graciously accepting our invitation to participate in this conclave and share their valuable insights. I would also like to welcome Embassy REIT, Trilegal, SR Associates, NROC, and HBIT, who are our associate sponsors, and Invest in Pre-Leased, our supporting partner. The Chamber has played a pivotal role in shaping Mumbai's development throughout its rich history, including facilitating the establishment of the railways and the Bombay Port Trust, while consistently fostering a business-friendly environment in both Mumbai and India. Our commitment to nurturing a culture of technology and innovation remains strong. As we act as a bridge between the business community and the regulatory bodies to enhance the ease of doing business, we are dedicated to promoting growth through robust financial structures, ensuring that this growth is sustainable, equitable, and inclusive. At Chamber, we are continually unite leaders from Indian industry and collaborate with government and regulatory authorities. This year, our mission statement, Collaborative Development Towards a Viksit Bharat, focus on 4 key aspects: embracing digitization, integrating ESG into business practices, improving ease of doing business, and promoting diversity, equity, and inclusion. We are committed to delivering the impactful result across these 4 pillars. In line with this mission, we have hosted numerous high-level events addressing critical topics. Our series on SM REIT began with a successful conclave titled SM REIT Ownership to Opportunity on 28th May 2024. Followed by an exclusive roundtable conference with select fractional ownership players on August 6th. Today, we are having SM REIT 2.0 Conclave, provides an essential platform for dialogue between industry and regulator. With the potential of market size for small and medium real estate investment trust in India projected to be exceeding 60 billion by 2026, now it is an opportune time for this discussion. The regulation for fractional ownership of the real estate asset is commendable and is expected to boost foreign direct investments from the retail investors globally. We have 2 panel discussions today: the regulatory framework and compliance, and on investment strategies and market dynamics, where we have the industry experts who will discuss and share their insights and experiences. I'm sure the takeaway after the session today will be immense. As we begin today's proceeding, I would like to invite Mr. Sanjay Dutt, MD and CEO of Tata Realty and Infrastructure Limited, to set the theme of the event. Over to you, Sanjay.
Very good afternoon. It's an absolute privilege to have you all in this one room. This is the tipping point in the real estate industry, in my opinion. I've had the pleasure over 30 years of experiencing some historic moments in the real estate landscape, which very often go unnoticed. And I can tell you, this is one of those moments. India has 700 million square feet of office space in the top 8 cities. And let me define office space to you first. The office space back in 70s was Kasturba Gandhi Marg and Barakhamba Road in Connaught Place, Nariman Point in Mumbai, MG Road in Bangalore, MG Road in Pune, and Anna Salai in Chennai. These were buildings with 500 square feet to 700 square feet offices. Average size of the building was 2 lakh square feet, maximum 14 floors. FSI consumption was 4, vis-a-vis land. This is how the corporate world and office space started in this country. The first generation of technology or IT parks, which was coined, started in 97, when the average floor plate of the building was 50,000 square feet, and the average absorption in the country was 5 to 6 million square feet per annum. Then came the second generation of IT office space. It was special economic zones. And it had a sunset clause, which we all know. And from 5 million square feet of Cuff Parade and Nariman Point, and 2.5 million square feet of Connaught Place, and about 1 million each for the rest of this country. The total size was 10 million, 12 million square feet roughly in this country. Today we are 700 million square feet. The next round of growth of the office space in non-SEZ, and these are 2 segments. One is the IT park without any tax benefit, because corporate taxes has been lowered and there is robust demand in the market. Then there is a corporate office space, which is CBD, Central Business District Developments. Central Business Districts are basically Barakhamba Road or BKC, such places where the rentals are much higher. On an average, you will see roughly 35 to 40 million square feet net absorption across the country every year. But for the first time in the history, in 2024, calendar year, Jan to December, India will witness the highest office absorption in the country. And I wouldn't be surprised. We've touched 39 million square feet in the first half, net absorption. And it's likely to touch, the guess is somewhere around 65 million square feet net absorption. Some are saying gross figures of 80 million square feet. 80 million square feet in 1 year as an incremental office space demand. And this, let me remind you, is confined to only 8 cities. But the India story is beyond those 8 cities. The India story is beyond in my opinion, 20-odd cities, where the absorption of office space is not tracked and recorded by any research agency properly. We are grateful to SEBI and Mr. Rao in particular, who have pulled out this ace to transform this country's unorganized sector, where developers were doing strata sale properties, small units. They were selling like residential units, unregulated, occupied by small and medium companies, is now going to be institutionalized. So this will be a journey of institutionalization of roughly 300 million square feet outside of these 8 cities that I just spoke about, which means we are roughly 1 billion square feet grade A asset, which is investor grade, quality, good title assets. So the opportunity immediately, I'm not surprised with the statement made by Gayatri earlier, $60 billion, if the right policy framework, if the right organizations with quality management expertise, right ethics and governance and compliance, following the rules and guidelines of SEBI are followed, this sector will open up huge opportunity for entrepreneurs, for developers, as an opportunity to monetize their assets. Today, the REIT industry has almost got about 200 million square feet listed. About 150 million square feet is also getting listed shortly in next 12 months, which means out of 700 total, really 300 plus 50% will be REITed. The portfolio which I was talking about, the top 8 cities. So this is an institutional journey. It's a huge opportunity. So I think this is that moment when the developers, the investors, the retail investors, if I may say speculators and investors, because there's a lot of speculation that happens in real estate, will get mitigated. And the related risk of making an investment in real estate without doing a proper due diligence, title, management, asset management, property taxes, making sure how do we calculate our return on investment post-tax on annualized basis. All this science and learning will get penetrated to every retail investor in this country. So I think it's a huge opportunity of learning, growth, and we are simply delighted that we have with us an expert panel. We'll have 2 panels, and we have this amazing theme, which I'm personally looking forward to. Despite being in real estate sector, something like this I've not experienced so far. So with that, thank you very much. I would like to now invite Mr. Rao. Mr. Rao, thank you so much for coming and joining us. Please join us on the stage. Thank you.
Good afternoon to all of you. I'm delighted to be here at, as Ashith bhai said, the 3rd time that Bombay Chambers is hosting us on SM REITs. Indeed, I think, on the earlier occasions, I had a particular sort of mission, if you will, which was just to sort of alert people that we had a September 8 deadline for those that were operating prior to our regulations coming into force in March to come ahead and apply and so on. Today, I guess that deadline is passed, and we do have 2 registered SM REITs already and 4 more in the wings. But having said that, let me, sort of go into the theme of both this event and talk a little bit both about the background and what I think lies ahead. So one, to me, I came across a recent report which actually puts the real estate, or rather it calculates, computes, the wealth of Indians and sort of says that wealth held in form of real estate exceeds half of exactly the total wealth in the country. Beyond that, it says gold is the next highest at 15% of what Indians have as wealth. It goes on to say bank deposits is roughly about at 13%. Equities, with all of our market which has risen the way it has, is at 5.8%. And insurance and pension just a tad behind at 5.7 each. To me, what it represents is sort of just a mental picture of saying that the wealth of a lot of, therefore, individuals and so on is really in real estate, right? And we will probably go into that as well. But globally as well, real estate is the single largest asset class, and by value estimated to be about USD 280 trillion, right? And the next set of asset classes which come in, both equities and bonds of governments, of corporates and so on, are at 100 trillion each. So again, the scale at which real estate sort of dwarfs wealth is something to be sort of appreciated. Having said that, I wanted to visualize this journey of an individual who sort of looks at real estate. Real estate requires both a large outlay to acquire and hold. There are challenges of figuring out a lease and putting it out to a person who will rent it from you. there is illiquidity, and whenever one needs money, it's very difficult to, sort of sell a portion of that real estate. You probably have to be all in or all out. There is that lingering uncertainty of when a transaction will occur. There are times properties don't sell for months on end. So again, that becomes a big challenge. Even if one wants to borrow against the property, the process of finding a lender at the right rate, at the required speed, along with valuation, title search, and what else that a lender requires, sort of again puts this real estate at a real illiquid situation. And now, if this was the situation with residential, when you add the commercial property if an individual aspires to own, I'm saying that much more complexity now enters, because now they have to find a corporate lessee, they have to find somebody who expects a particular level of, like we say, grade A kind of property, it being maintained and so on. And some of these challenges even sort of confront institutional investors. I think with REITs, InvITs, and now SM REITs, the goal was to convert such physical real estate assets into financial assets. And to me, that sort of is what I would believe are what these asset classes are sort of addressing. So the outlay for participating can be as low as 10,000 rupees for a regular REIT or for a publicly listed InvIT. For SM REITs, it will start at 10 lakhs, and I'll come back to that in a minute. There is an investment manager who takes the onus of managing your property for you. With the units that are listed, the minute you want to exit, there is an exchange which sort of facilitates that trade. As long as things are held in a demat form, there is nobody who's going to ask for a title report or whatever of the property. That is already in the public domain through the IM and the scheme offer document, which has sort of got floated. There are matters of diligence, disclosure that an investment manager is subjected to, not the unit holders, not the actual owners, but the person who's the intermediary. If one had to borrow, it would be borrowing against securities rather than against that real estate by a unit holder. We have our grievance redressal mechanism, scores, which becomes applicable. Similarly, there's effective dispute resolution in form of smart ODR. With both stock exchanges, because all these units are expected to be listed, you have a frontline regulator who's obviously looking at the listed entity, namely the scheme of a SM REIT. And there's also SEBI, which sort of both does periodic inspections and so on. I think all of these sort of lead to what I believe a huge level of investor comfort. Having said that, so therefore to me it is both financialization in a safe or safer environment, if I can call it that, and it's fractionalization. In fact, over the last few years, where we have reached with the total assets under management of REITs and InvITs is roughly about 6.5 lakh crores. In dollar terms, that's about $76 billion. And this is a journey just of a few years, if you will. While our regulations are about 10 years old, the first of the InvITs started, or the first of the REITs started in 2017 and 19 respectively. And today we have just over 30 registered REITs, 5 REITs, 26 InvITs, 2 SM REITs as I mentioned, and with 4 in the wing for SM REITs. And to me, that it happened without fanfare, that it happened without, sort of investor outreach and so on, which you see, let's say, a mutual fund industry do so well with the mutual fund Sahi Hai campaign, that the growth of REITs and InvITs occurred without all of that should actually give a lot of us a lot of confidence about what the future portends for SM REITs as well. To me, while I keep reminding people, especially those who practice fund management and have AIFs, we have 1,200 AIFs or so, and the total assets under management as of the year end March was roughly about 3 lakh crores. So this asset class has actually surpassed all of those 1,200 with just about 30 entities, and that's the real reason to cheer that we've just got started. And to me, I keep believing that the practitioners around the world keep looking only at our registered REITs and ignore our InvITs. So they end up thinking we have only 4 REITs and so on. But globally, the definition of REITs actually encompasses everything which we house even in InvITs. So my sort of message always in such audiences is please don't regard these as separate and distinct. We have REITs, we have InvITs, and we have SM REITs now. But the fundamental aspect of what is held inside, I think, comes down to that it is real estate in one form or the other. Even infrastructure at some level is that. And the way we have ended up looking at these three regulations that we have created, I would say where we have builders and developers being supported is through the REIT structure. Platforms which link builders and with investors would be the SM REIT platforms. And infrastructure asset developers with its many hues, because we have as many as about 15 or 20 types of infrastructure that can be housed in an InvIT, is again, the nuance there is that many of the infrastructure are what I call having a predefined life. So if it is a power plant, it will have a life over which it can be operated. If it's a toll road, there is a particular period of time that the toll operator can operate that road. So to me, that retransfer element is slightly different from regular real estate REITs or SM REITs. But to that extent, that is why the platforms are sort of segregated in these three manners. But having said that, I think it's good to just recap what we did with regular REITs. We began by stipulating that the asset which enters a regular REIT or InvIT has to begin with the minimum asset size of 500 crores. Frankly, that sort of has both played into the fact that we had large real estate developers, we had large infrastructure assets, and that sort of propelled where it's reached also. Equally, we required, in line with global practices, distribution of at least 90% of the distributable cash flows. We expected distinct managers and trustees and independent board members. And I think, again, a uniqueness which we brought, which was quite appreciated by investors, but surely by sponsors and developers too, was that we empowered investors. So unlike many other pooled investment vehicles, AIFs, mutual funds, or what have you, here the unit holders actually have a say. They actually have a say on a variety of matters. So unit holder, sort of votes on various things and so on. So that gives us, that participation, which I think is unique amongst various pooled investment vehicles too. We went one step further. We actually said that if investors holding 10% or more in a REIT or an InvIT want to have a seat at the IM, they should be sort of able to. And again, to my mind, that sort of representation again boosted a lot of confidence. Having said all this about regular REITs, I think what we began to realize is that the threshold itself was sort of making a different asset class sort of emerge in the ecosystem. And that was that investors were seeking discrete assets, concentrated exposures. And I think the fractional ownership platforms sort of addressed that market. And as we studied that market, I think we could see almost 10 or 15 players who sort of emerged. But in the aggregate, the assets which they were sort of funding or allowing the funding or finance of had almost reached 4,000, 5,000 crores. It's at that stage that we did a consultation, and we sort of brought both FOPs into the room, and I think we had a wide public engagement as well. And what it gave us was, I would say, the SM REIT regulations embedded, nestled in our regular REIT regulations, but allowing us to therefore create it as a distinct asset class. I wanted to delve a little bit on these fractional ownership platforms, also because of a conversation I just had before the start of this meeting. I guess a lot of people had this question in their mind that do I necessarily need to come into the regulated space? Do I necessarily need to come and register with SEBI as a SM REIT IM and do all of what I do? So again, to recap what these FOPs represent, I think one, unregulated. So clearly their product or what they do, there is no regulatory oversight. I think some of them did sort of go ahead and register themselves with a RERA or what have you, to sort of say, I am registered with somebody. But does RERA really look at this financing and this structure? I would sort of put a question mark on that. I think that RERA looks at builders and under construction itself is a great thing. But beyond that, to expect that they are looking at all these financing structure is expecting way too much. Equally, there was no uniformity or common disclosure standards or investor protection measures that the FOPs sort of created. They probably did disclose the property, they did disclose some valuation, but beyond that, what kind of contractual rights that they conferred on investors could vary SPV to SPV, or structure to structure, if you will, depending on what that or where that asset was. Means of exit for the investor by no means was assured. So they did say that we will make best efforts, we will try and figure out if there might be somebody who might come and buy and so on. But again, no sort of clear exit mechanism. I would equally say that many of them were in the gray zone, and I'm being a little charitable when I say gray zone, is that several of the activities that they carry on could be regarded as merchant banking, if you will. It is organizing, arranging, helping mobilize funds for a company or a partnership firm to acquire real estate assets. So to me, merchant banking takes those shapes and forms. They help mobilize funds for undertakings business, right? Equally, if they were making available offers to investors at large, that triggers deemed public offering when it is either debt or equity or both. So to me, again, when it reaches more than 200 investors as an offer, clearly there's a deemed public offer trigger that they have breached. Even if this is behind the wall garden, so many of the operators sort of have websites or apps where you register and then they say, we will show you offers if you are behind this wall. So it's not publicly available. But frankly, they're pulling wool over their own eyes, because if those people who are shown that exceeds 200, it's already a deemed public offering. If they decided to skip sort of doing a company structure or a partnership structure, it could be labeled as organizing a collective investment schemes. And again, SEBI has a rich history of both prosecuting and taking action against collective investment schemes. And finally, even this option of, like I said, matching buyers and sellers or providing this best efforts kind of thing, to us, it is like operating an unauthorized stock exchange. The minute you are on a platform and you are saying that I will help you find a buyer or I'll help you find somebody who wants to sell this interest, really what a person is doing is operating an unauthorized stock exchange. To us, all of these were compelling reasons to take regulatory action. And I think the way we chose was that we said, here's a framework we'll create. If people choose to come inside that framework, we will in fact not look at throwing the book at them for what happened in the past. But those who continue to do it, frankly, the end of forbearance is here, now that that 6-month window that I said has sort of expired. So yes, can there be action against those who are operating, breaching these norms, not registering with us as SM REIT, but breaching these norms? You can be rest assured that action will start to happen on those fronts. Having said that, let me move to what I think is 2.0 for real estate investors, for looking at what SM REITs and the schemes will sort of offer. One, we really expect SM REITs, as distinct from what happens in regular REITs, to follow a scheme structure. And what we mean by that is there can be multiple schemes that IM can establish, each scheme to have assets at least between 50 crores to 500 crores, with no limit on number of schemes. So there can be indeed multiple schemes that the IM can establish. Each scheme is distinct, segregated, distinct set of investors. There is no maturity date that we expect being put on a scheme at all. So hence, it will have perpetual existence unless the unit holders choose to sort of wind it up or say that dispose of the assets and close the scheme. Each scheme has to be publicly offered in lots of 10 lakh. Again, the way we have chosen or way we have thought of this is that over a period of time, we will look at whether to scale down this lot size and keep bringing it lower and lower, as both we become familiar with the product and with the people who are managing all of it. Similarly, we have stipulated that the schemes can only acquire SPVs set up as companies which own completed revenue-generating real estate assets. There are uniform distribution norms, so 95% of the income has to be upstream by the SPV to scheme and 100% by the scheme to unit holders, at least with a quarterly distribution. At the time of launch of a scheme, leverage has to be decided on by the IM. If unleveraged, then the IM is required to hold only 5% in the scheme. If it is leveraged, then the IM is required to hold 15% of the units at inception and then can gradually scale down the holdings. In fact, this requirement of IM holding units achieves what we call alignment of interest with the unit holders and can be regarded as the IM having skin in the game with the investors. This should again give a whole lot of comfort to investors that the IM's interests are fully aligned with their own. To eliminate further potential conflict of interest, no related party transactions are permitted between a SM REIT scheme and persons related to the IM as well, including property management or housekeeping, where traditionally some of them have played the role. We've again clarified through our FAQs that the IM itself can undertake this divisionally, so it need not be outsourced at all. They can service it on their own, or indeed outsource it to unrelated parties. Unit holders have uniform rights. No superior or inferior class of unit holders is permitted, nor is there any other ownership interest permitted in the SPVs. They have to be 100% owned by the SM REIT scheme. Like I mentioned, unit holders have a right to participate in voting on various matters as specified. For making the public offer, what we have stipulated is that the IM has to engage a merchant banker for the drafting of the offer document, utilize the book building process of the stock exchanges to accept bids from investors using ASBA, follow due process for allotment, listing, and post-issue listing report by the merchant banker, and issuance of units only in a demat form. To me, each of this structure and the way we have thought of it is in a way time-tested. If you think about all of the regular IPOs, main board IPOs which occur, they ride on such a system. And indeed, they have galvanized a lot of investor interest for those that use this mechanism. So we frankly believe it will actually go ahead and expand the reach of those who choose to operate in the regulated space and bring such schemes. To look to the path ahead, I think one path is definitely that of compliance, as this theme sort of underscores. But I think the other, which I believe, is that if genuinely in 5, 6, 7 years, we could achieve a $75, $76 billion assets under management of regular REITs and InvITs, I was pleasantly surprised to read then a CBRE report which said that by 2026, 27, this will reach $60 billion. And I really think we are just barely scratching the surface. To me, there are so many asset types and so many asset opportunities which exist within the country that I would sort of go to this theme of, and I know Sunil spoke a lot about how much is the net asset addition that we are having to grade A commercial property. But within the four real estate REITs, or rather the four REITs that are functioning at the regular level, 3 of them are focused on commercial real estate. And between 3 of them, they have about 15% of grade A commercial property, right? To me, the similar number in US is that it reaches closer to 80%. Similar number in Singapore, commercial grade A property owned by REITs is in excess of 50%. So to me, just the runway on regular REITs and what they can look at commercial real estate already is there. And if SM REITs joins that chorus, and indeed in slivers of 50 to 500 crores, to my mind, genuinely, the market is quite rich. There are players who've sort of come forward and told us, can we actually see, for instance, hospital assets being housed inside a SM REIT scheme? And what does it do? It sort of flips, the asset from an owner into the scheme and allows them to go ahead and create a further network. You can do the same for schools, you can do the same for nursing homes, and what have you. To my mind, I think, indeed, like I said, if 50% of India's wealth is held in form of real estate, that to me is the opportunity. And indeed, for those of you who advise or tell players who are looking at this structure, I would tell you, please tell them to come and register, because the runway that they get as a regulated entity is far, far greater than being in the unregulated, having all of the regulatory risks that they carry, where indeed, as I said, the limits of forbearance will be at an end, and they may be at the receiving end. To me, we've equally, just 2 weeks ago, we announced the launch of something called Data Benchmarking Institutions. What it does is it focuses on REITs and does a drill down at 2-3 different levels, both in terms of looking at the actual financials, so they allow comparability between different REITs. It allows a drill down of the properties owned by those REITs and to adjacent properties that are available in that micro market. So that's another sort of thing. And the third, what it has done is it allows you to look at valuation reports and play with those valuation reports assumptions too. I'd request you, please check out these data benchmarking institutions. There are 3 of them which are operational by CAMS, K-Fintech, and CareEdge. And to me, what we already told them when they launched it was what we have in mind is really SM REITs coverage. Because these 4 are indeed, very small in quantity terms, but we really expect the SM REITs to really grow and have multiple schemes. So we want all of this data benchmarking actually to be primed for what you do for, the SM REITs. I wanted to share all of that and sort of end with saying we remain open to feedback. There are several of these conversations we held, both in explaining about the SM REIT structure, our approach, and so on. In course of that, we've gathered very valuable inputs. Some of them require a relook at our regulations. Some of them require us to make sure that we are clarifying in our circulars or in our FAQs. The easiest ones have been done, so FAQs have sort of got done. Those in the circular and regulations are under consideration, and hopefully you will start to see some of that play out as well. With that, let me close this. Thank you again for having me here, Bombay Chambers.
Sir Shri Rao, if you could just join us back on stage for a small photograph and also for memento, sir. Thank you. I invite our Director General, Mr. Sandeep Khosla, to kindly give a memento of appreciation. We'll have a question Q&A session. We can also have, we've got time for some Q&A, so questions from the audience are invited. Thank you.
So Bombay Chambers wants to make sure I earn that memento. But yes, please.
Hello. Mr. Rao, fantastic. It was an amazing, we're all learning curve. Tour was set by Sanjay Dutt. A very small question. I mean, I'm still into real estate, broking business and try to understand this. But whatever feedback we have got, though we have 2 SM REITs successfully registered, but there is still a lot of resilience happening. I mean, there's a lot of the FOPs are not very keen on, coming on the SM REITs. So what is your perspective on that? I know you did some kind of a clear-cut, that there are a lot of compliance issues, but I still feel that there is still a gray matter right now at this moment of time. How strongly are you going to be advocating it, and how important it is that the FOPs who are not looking at coming on the SM REITs, they, come on this side of the...
See, I guess to me, the knowledge about that we were coming in to regulate this was known probably from last year onwards, when we floated our consultation paper and went through, in fact, not even last year, I think the year before last. So we've followed a lengthy consultation period. We've sort of framed regulations in consultation with both the existing operators and those that we gathered as public feedback. But truly, I think that we have 6 applicants, 2 registered already, sort of gives me the confidence of saying I think we are on the right path. In terms of those who have chosen not to, I think it really should be to them that you should ask why not. Because here's a regulator who's willing to listen. Here's a regulator willing to sort of attend to issues. Like I said, candidly, there are times we can clarify through a FAQ, and we've indeed chosen to do that. There are times we can update our circulars and so on, and we do that. It's regulations where we take time, but again, it's not that we have had a closed mind to saying that we will revisit that if that is what is required. But that chorus, that voice, truly to me has been, is it really worth it or not? I think that's really the question in their mind. My own words to them have been that if you have so far thought small, let's assume you're not tripping any of these wires of what I said exist. You can't cross 200 investors, you can't sort of make, exchange operational or what have you. Let's say you don't do any of that. You will probably remain small player. Why do you want to remain small? Like I said, the opportunity is so huge. That huge opportunity becomes available to you the minute you are part of a regulated system. So that's sort of my words to them. But yeah, I think I can't answer why they are not here, but truly they should be on the regulated space. I think as the confidence builds with those who have chosen to come in, and as probably our forbearance ends, and which I'm saying it is ending, and those regulatory actions start to happen, maybe things might change. But it should not be because you are at the end of a stick that you're coming and registering. I would have thought that the framework itself is so good and flexible, and obviously it makes for where you can engage, should have been the reasons to do it. But let's wait and watch, is what I can say.
In too early, we only have a commercial asset right now. Are we probably venturing into the other asset classes like residential or?
So in our mind, in our regulations, we don't restrict. As long as it's a completed revenue generating real estate asset, it's game for what can come inside a SM REIT. So it could be residential, it could be, like I said, a hospital asset or a school asset and so on. So there is no, it's really about, what the imagination of the SM REIT IM is and what the investors think is good. So.
The fact is that the first session, we are only a handful of people and we're getting in more chairs. So I think this is the good beginning right now, Mr. Rao. Thank you.
Wonderful to hear that. Thank you.
Yeah, I think the first, as he referred to, the first session was good, and they spoke about return of investment, something. Here also, the first half of the structured approach is clear, very much clear. The way you explained, very well grasped. Now the second, the ROI, return, and the tax implication, whether it will be treated as a rental income or capital gain when we exit something. Little bit of, it is a little away from your core kind of taxation, but still, as of today, what is the prevailing situation on taxation? Yeah,
so you are quite right. I'm not the right expert to tell you on taxation, but what I can just say is that, well, it has served the REIT and InvIT market very well. So that same structure applies to SM REIT schemes as well. I think it follows, the principle of that the entity level, there is only tax incidence at one level, either the investor or this scheme. It is not at both. I think that's the sort of pass-through status that SM REITs get just as regular REITs and InvITs. But I'm sure there are more experts in this room, and perhaps Bombay Chambers can do a special session just on tax. That I'll leave to them. But do excuse me from commenting more.
Good afternoon, sir. One question was, what was the thought process while differentiating, let's say, a seller and investment manager? Because the related party transaction norms are there, and one of the worries whether this will prove to be counterproductive.
See, like I said, I think we ended up seeing a lot of the fractional ownership platforms, and they were unaffiliated to any specific builder, right? And I think that sort of played in our minds quite a lot, and their feedback that yes, they can be independent, of the broker, of the builders and of the investors, and therefore as a platform, operate as a platform. I think that is what shaped our SM REIT framework, so as to speak. Is it different and can builders look at regular REITs? By all means, there is no prohibition at all. But I think it requires a particular size and scale. Like I said, the beginning asset, there the value is set at 500 crores or more. So there a regular developer can indeed come in and set up a regular REIT as well. But here we chose a platform, if you will. Yeah.
Thank you, sir.
Hello, sir. My name is Pradeep and I am from Grant Thornton. Thank you for your input so far on the unregulated aspect of the fractional ownership. My question here is specific on the infrastructure list, harmonized list, which includes some of these hospitality, hospitals, warehouses, etc. Now, the real estate regulations defines real estate asset to include some of the real estate rent yielding assets, excluding these assets which are part of your harmonized list. Now, you said that like hospital assets, if they are rent generating, they can be included as part of REITs, right? So for example, warehouses, we are getting a lot of queries where people want to do this logistics as a rent yielding property. So is that something permissible? And if yes, whether the definition under the REIT regulations will support that?
So the quick answer, I come back to this feedback loop that I said we have gathered. So this belongs in the category where we have to revisit the regulation. If we want to allow assets, which are otherwise in the harmonized system of nomenclature for infrastructure. So yes, that requires a revisit to the regulation. Otherwise, people have to be mindful of what is counted as infrastructure and not as real estate, and vice versa.
But in terms of SEBI's objective, like while the regulations may be amended, but what is the outlook of SEBI on this? Do they intend to cover these kind of assets under the rent yielding category?
So that's what I'm trying to say. So that requires a change to the regulation. We follow a particular approach when it comes to regulation change. So it begins with people giving us inputs. We go to our advisory committee. We float a consultation paper. We gather public feedback. We go to our management and then finally to our board. If our board agrees is when the regulation gets changed. So for me to jump that queue and sort of tell you, yes, it should be or shouldn't be, will be jumping the gun. So I have to follow that process. But indeed, it is one of the feedback we have gathered in course of our interactions and which we will internally figure out whether it will follow this path that I described.
Sure, thank you. And second we are getting a lot of queries from many people who want to do these SM REITs. Now for smaller assets, like which is like between 50 to 100 crore, the asset side itself is small, they going into this IPO process, and the IPO cost and all these costs almost go 4 to 5% of the total funding. So that appears to be counterproductive, at least for these kind of asset class.
See, it's not stopped the SME IPOs, right? And we can see that it's grown quite a lot. I think there are people who emerge at all price points, including bankers, including people who support these issuances and so on. So I think just to say, oh, that process is so expensive, I'm just saying, well, staying out of it probably is going to be more regretful. Right?
The only feedback which we are getting is that in the SM REIT appreciation in the unit price, so they have studied the existing REITs and the prices. So there has not been a significant appreciation compared to other products. So that's where they are coming from in terms of getting into SM REITs.
So let me, I'm glad you picked that up. I don't think REITs, InvITs or SM REITs deliver to you capital appreciation. I think they deliver to you returns from that property. That property may appreciate over a period of time or may not. But I don't think people come in for appreciation. Please go to equities or do some other asset class. But don't confuse what you want from an asset class, saying I'm always looking for appreciation. Then this asset is not for you, right? If you want what I call an inflation hedge, that real estate prices, the rental yields will sort of reset every 3 years. You've heard of the demand which exists. You've heard of what growth it exists. That can be a driver for people to decide to come into this asset class. But it should not be to saying, oh, I'm expecting appreciation. That appreciation is better delivered by equities, and people are indeed better judges of participating there. But to say, no, I'm expecting this from this asset class too, I don't think that's the right approach or that's the right view. So,
sir, only last request will be to, if SEBI can come out with clarification on the assets which are below 500 crore and which fall under the harmonized list. I think so a lot of queries are coming from that segment where they are not able to do either the InvIT or the SM REITs.
So like I said, it touches the regulation. Changing the regulation requires the process that I described. I can't clarify my way out of a regulation. So please bear with us as we factor
Sure.
all of it in.
Sure. Thank you so much. Thanks.
Thank you.
That would be all of the questions.
Thank you.
So much.
Thank you
So
again.
please stay back for the memento. So after these questions, I request our Director General to kindly, Mr. Sanjay, to kindly give the memento. Thank you. We'll just go ahead with a small break and have these conversations outside, a very small one of 5 to 10 minutes. We are awaiting Mr. Hiranandani, who's been stuck in traffic, unfortunately. And just a small request also, I would request panelists of panel 1 to kindly meet Mr. Kailash Babbar, the moderator. Just a small conversation he wants to have before the panel. So, Mr. Sudeep Malik, Dr. Hiranandani, who's not here, Mr. Ruchir Sinha, and Mr. Sandeep Bakat, please. So, Mr. Kailash Babbar is here, so if you could just meet him here.